On the 19th of May 2005, Michael Burry purchased his earliest credit default swaps in the prediction of the housing crisis. Over 60 million was bought from Deutsche Bank, 10 million individually from 6 separate bonds. He forecasted that the United States mortgage-backed security that used to be a solid and respectable investment product had gradually become a dangerous and misleading time bomb. He said that this was caused by selfishness and corruption. To Michael Burry, this bet wasn't a gamble. He made sure to do all the research. He examined every document. He was sure of what the result would be. His only problem was that the rest of the world didn't do this. It would take the rest of the world an additional 2 years to even begin to start searching. It didn't take until October 11, 2007 for the S&P 500 to climb at 1,576 points. And in the 18 months that followed, on March 10, 2009, the S&P was closed at 676 points, a whopping 57% crash. However, in the end, Michael Burry made a personal gain of $100 million and also made over $700 million for his investors from his same bet. In the years that led up to this overwhelming achievement, he was constantly criticized by the investing community. Even his own investors criticized him. Eventually, this led to Michael Burry closing his fund after everything that had been said and done. But you may be wondering, why bring this up now? Well, you guessed it right, history is repeating itself. And the first person to realize that something was wrong in the promising mortgage market was Dr. Michael Burry. In February last year, Michael Burry first alerted the world of increased inflation as a result of the Fed's unexpected money printing. He made out tweets telling the public to prepare for inflation. He did this hashtagging the phrase "doomed to repeat" and calling out the United States government and also the Federal Reserve. They were questioned over the trillions of dollars in stimulus they had done, and at this time, he was the adversary. Then, it all looked rosy. The Federal Reserve was printing that money, but inflation was still quite low at the time. The recently published data notified us about an annual inflation rate of 1.7. This was quite lower than the Fed's target, though. But as Burry predicted, fast forward 12 months and we're now facing a blistering inflation rate of 8.6. Michael Burry obviously came out to make a tweet. He referenced a tweet earlier made by Elon Musk where he tagged Dr. Burry as a broken clock. In all of this, what is quite interesting is that in the past month, Michael Burry has been everywhere, not just doing victory laps. Instead, he's been coming out to explain quite extensively on Twitter why he knows this economic crisis and consequential market downturns are just the beginning. Now, I wouldn't want to be the guy that predicts apocalypse or anything on the channel, so try not to make this video as me crying out in fear. However, what I want to do is cover Dr. Burry's complete rationale to fully understand what he's thinking. And obviously, the message he's mostly been passing across is that he believes the worst has yet to come. To start, Michael Burry believes that the S&P 500 will lose another 50 from where it stands now. On the 3rd of May, Dr. Burry tweeted, "Regarding paradigm shift speculation peaks, the SP 500 bottomed 13% lower than 2002's bottom in 2009. 17% lower than 1998's LTCM crisis low in 2002, and 10% lower than 1970's low in 1975. 15% lower than the COVID low is SPX 1862, Shiller PE of 16, nominal PE of 9 in historic range." You'll have to read that one a few times to understand that phrasing, but what he's stating is that the trend over the last 25 years is the bottom of the present market crash is often lower than the crash that came before by over 10 to 15%. He also added that 15% below the S&P 500 low that took place in 2020 takes the US to 1,862 points. This is absurd because it means that Michael Burry is predicting a peak trough decline of 61.4%. This would take the US down to the historical normal Shiller PE of about 16. From where we are presently, Michael Burry has forecasted an additional 50+% drop-off in the stock market. This is not only an audacious prediction, but one that has met criticism in the past. Over the weeks that passed, we've witnessed the market bounce back 6.5%, but this doesn't indicate that we're home and dry. As we've seen in the past few days, short-term bounces don't mean we're out of the woods. And yes, Michael Burry commented on this likely scenario. He tweeted, "Dead cat bounces are the most epic. 12 of the top 20 NASDAQ one-day rallies happened during the 78% drop from 2000's top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. That's obviously a lot of numbers to understand, but what he's getting to here is that even during trying times, the statistics indicate that it is normal to see short-term recoveries among the long-term downward trend. Out of the leading 20 Nasdaq bounces, 12 took place along this slope. Also, out of the leading 20 S&P 500 bounces took place along this slope. Well, he wasn't done. On May 5th, he added, and I quote, "After 2000, the Nasdaq had 16 bear market rallies, more than 10% averaging 22.7 before bottoming down 78%. After 1929, the Dow had 10 bear market rallies, 10% averaging 22.8% before bottoming down to 89%. With this, it seems that Burry is quite confident that we're just in the early stages of a far bigger problem here. And to make us understand even more, he took out time to comment on the relatively diminished trading volumes we've encountered during the 2022 crash thus far. Michael Burry tweeted, "Top to bottom, MSFT traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. AMZN traded 5.7 times by 2002, 6.6 times by 2009, and 0.9 times so far. JPM traded 3 times by 2002, 5.9 by 2009, and about 0.7 so far, etc. Enough takes time." So in honesty, when you look at the trading volumes, although we've witnessed the market cool off a bit this year, and everybody seems bearish from words that are going around, however, the selling hasn't even begun. Just take a look at the charts. Withdrawals from the market have not begun, yet money still seems to flow into the market. Michael Burry anticipates that we're possibly going to witness more selling volume coming over the next couple of years. This would of course result in higher declines in the stock market, and this is a case Dr. Burry wouldn't want to face, as he stated in a tweet recently. On May 24th, he tweeted, "As I said about 2008, it's like watching a plane crash. It hurts, it's not fun, and I'm not smiling." And this is one interesting aspect of Michael Burry that you shouldn't forget. Dr. Burry has seen this all happen in the past. Firstly, through the dot-com bubble, and secondly, in 2008. He's witnessed these patterns of behavior repeat themselves over and over again. He's examined greed, corruption, and the excessive market booms and busts. And this is exactly why he is so confident when addressing these issues. Recently, he posted an eye-opening cherry to his Twitter. In one of the images he posted, we see the 100-year S&P 500 lead into today. And in the second image posted, we see the lead-in to the dot-com bubble. In the last image, we see the lead-in before the Depression. Let me tell you, it is quite scary just how similar they all are. Well, Michael Burry didn't stop with the posts. He did well to follow them with a comment. He tweeted, "Third time's a charm, 10 years leading to a financial crisis, yellow S&P 500 2000, white S&P 500 today, green Dow 1929. Got to love human nature, nothing if not consistent." For him, he's seen this all before and he understands where it's all leading. It was just 12 months prior that we tweeted that he saw the greatest speculative bubble of all time in all things, like 2 orders of magnitude. Maybe to him, it's been pushed to its limit. However, this is obviously all just the stock market. We mustn't forget the primary reason behind Burry's view is the economy. We're all aware of Burry's view on inflation. And of course, we know the Feds are raising the interest rates to make borrowing way tougher for businesses. But we have to know that interest rate increments also impact the fundamental foundation of the economy, the consumer. In abrasive inflationary environments that result in rises in inflation rates, unfortunately, the consumer has less money to expend due to more of their savings and income going to servicing their debts. This will result in somewhat of a negative downward spiral because less discretionary spending will lead to fewer sales for industries we invest in. And Burry is also quite worried about the reduction in savings, not just because it forces individuals to use their credit cards more, but also because it reduces savings, which leads to less spending, and this affects businesses. So, in summary, to Dr. Michael Burry, we're dealing with inflation, hikes in interest rates, and a reduction in consumer spending, which has lowered ratings on stocks and the profitability of businesses. This is a really interesting topic to look into, because for sure, no one knows where we are headed next. However, do well to let us know what you think about Michael Burry's predictions in the comments section below. I'd love to hear what you guys think. Like this video if you found it insightful, and subscribe if you'd like to see more videos like this. Thanks very much for watching, and I'll see you guys in the next video.